OG John AG checking in. If you're active on Twitter, you already know exactly how this has been unfolding. Silver has officially cracked the 90 to 95 support zone we highlighted ahead of time. And just like we explained would happen, once that level failed, it cleared the runway for our next downside target at $86. Price did reach that zone, but it didn't stop there. As I'm recording this right now, silver is trading around 78. So what's driving the continued downside pressure? The catalyst just dropped. President Trump has officially nominated Kevin Warsh as the next Federal Reserve Chair, not Judy Shelton. Kevin Warsh is well known for calling quantitative easing a reverse Robin Hood policy. He openly supports rate cuts, paired with balance sheet reduction, not unlimited liquidity injections. This is precisely the scenario we warned about in the last video. We were very clear. If Judy Shelton, a vocal advocate for sound money, was not chosen, prices could fall below 86. That is exactly what played out. Markets are now pricing in a Fed chair who could be restrictive when it comes to balance sheet expansion. And silver is reacting accordingly to that shift in expectations. Markets are in full-blown panic mode. Gold dropped hard. Silver got crushed. Bitcoin sold off aggressively. Meanwhile, the dollar surged. And here's the key point you need to understand. None of this is random. This is a coordinated shift in policy expectations away from endless money printing. And for the first time in years, the paper markets are being forced to acknowledge that reality. Quick reminder before we continue. If you're not following me on X, you're missing real-time charts and data that I simply can't post here. The handle is OG John AG on both X and YouTube. It's verified and can't be duplicated, so ignore the imposters. I don't sell anything. No courses, no signals, nothing. Just unbiased information meant to empower independent thinking. Your feedback matters. Drop a comment below with where you're watching from and your price prediction for next week. I read them and will address your questions. Now, before we go deeper, I want to speak to two very different groups watching right now. First, the long-term physical stackers. You're looking at this pullback and smiling. You're probably already in the comments saying you're ready to buy, maybe even sitting back enjoying the volatility with some popcorn. Your time horizon isn't measured in days. It's measured in weeks, months, and years. This price action is just background noise to you, a temporary discount on real money. You're accumulating metal regardless of short-term paper manipulation. And this analysis only reinforces your strategy. Buy physical, stack into weakness, ignore the paper price circus. Then there are the short-term traders. You're watching these technical levels closely because you're actively managing positions. You're dealing with leverage, stops, entries, and exits. For you, daily price movement matters. The technical roadmap I provide is designed to help you survive this volatility without getting wiped out. Both approaches are valid, but you have to know which one you are and operate accordingly. So let's connect the dots from the previous video to what's happening now. I laid out the exact technical roadmap in advance. I said the 150-hour EMA would act as support initially, and it did. Price bounced roughly 10%, but then selling pressure overwhelmed that EMA, opening the door to the 90 to 95 support zone I identified. I said if that zone failed, 86 or lower would be next. That level broke, we tagged 86, and now we're trading at 78. The roadmap unfolded exactly as outlined. I also discussed the Fed chair decision under two distinct scenarios. I said if Trump chose Judy Shelton, gold and silver could experience the largest intraday rebound in history because her support for a gold standard would represent an existential threat to the paper manipulation system. But if Trump went another direction and did not choose Shelton, the fight would continue, and prices would fall to 86 or lower. Trump chose Kevin Warsh, not Judy Shelton. He's not conventional in the Powell or Yellen sense, but he's definitely not Shelton. The no Shelton scenario played out exactly. We hit 86 on the nose, then continued lower to 78. The technical breakdown and the policy outcome converged precisely as predicted. Kevin Warsh isn't a new figure. He served on the Federal Reserve Board from 2006 to 2011 and played a role during the 2008 financial crisis. Since leaving the Fed, he has become one of the most outspoken critics of post-crisis monetary policy. He has repeatedly argued that QE inflated asset prices, widened inequality, and primarily benefited financial markets rather than the real economy. He has openly labeled QE a reverse Robin Hood policy. He's also stated that the inflation surge after 2020 was a policy error, not some unavoidable accident. Here's the critical distinction. While Warsh now supports cutting interest rates, his framework is fundamentally different from what markets have grown accustomed to. He advocates rate cuts paired with balance sheet reduction, not open-ended liquidity expansion. This is a massive issue. Markets are starting to price the risk that rates may fall, while liquidity does not expand the way it has in past cycles. That combination is toxic for leverage trades, stretched equity valuations, and liquidity-driven rallies. Put simply, Trump wants lower rates. Warsh wants balance sheet discipline. Markets are terrified of rate cuts without QE. The era of guaranteed QE is no longer assured, and markets are finally being forced to price that reality. Yesterday's sell-off began the moment the probability of Kevin Warsh becoming Fed chair spiked. Gold, silver, and Bitcoin all dropped sharply. The dollar surged. This was a policy-driven move, not a technical accident. Now let's shift focus to the physical market, because this is where the real story is unfolding. While paper prices are getting obliterated, Shanghai spot silver is currently trading around $122.45 per troy ounce. Meanwhile, COMEX silver sits at $78. The Shanghai premium is now over $44 per ounce, a 56.83% premium relative to Western paper prices. Physical silver in Shanghai is trading nearly 60% above COMEX. Let me repeat that, nearly a 60% premium. Earlier, when COMEX silver hit 86.6, the premium was already over $30. Now COMEX has dropped further to 78, yet Shanghai is holding around 122. The premium expanded to $44. Why? Because this isn't a momentum trade. This is a war of exhaustion. China doesn't need silver to skyrocket overnight. It doesn't need panic. It doesn't want a sudden reset or headlines screaming systemic collapse. All it needs is a steady 19 to 20% premium over Western paper prices. Following Western price movements doesn't signal weakness. It signals control. Physical metal continues flowing east. Paper markets continue fighting themselves. Slow pressure beats explosive moves. Think of it like fishing. You reel in, then let out over and over again. That's enough to quietly signal physical stress, drain inventories, force COMEX margin hikes, and allow paper markets to bleed on their own. And speaking of margin hikes, breaking news. COMEX just raised silver margins to roughly $52,000 per contract. That's over $10 per ounce just to stay in a 5,000-ounce silver futures contract. What does that mean? More cash required or you're forced out. Leverage gets crushed. Weak hands get liquidated. Paper liquidity evaporates. Margin hikes don't happen in calm, healthy markets. They happen when volatility spikes and systemic risk increases. This affects paper traders, not physical silver holders. While paper tightens, physical silver continues moving, delivering, and disappearing. Less leverage, fewer paper games, more stress where it actually matters. And the physical stress is undeniable. Another 5.6% was drained from Shanghai vaults in a single day. Silver continues leaving at a rapid pace. Silver closed at 125.4 on the Shanghai Futures Exchange. Gold closed at 51.97. Another 26.94 metric tons of silver were removed from SHFE vaults on Friday. Total SHFE silver inventories are now down to just 455 metric tons, roughly 14.6 million ounces. Vaults are being drained while paper prices are collapsing. Connect the dots. Here's the mid-video reveal that changes everything. While the West is panicking over Kevin Wersch and dumping paper, look at what's happening physically. The Shanghai premium expanded from $30 at $86 COMEX to $44 at $78 COMEX. COMEX fell $8. The premium rose $14. That's not panic selling in China. That's deliberate accumulation. China is letting the West destroy paper prices while quietly buying physical at any level. And it's not just private market participants. Governments are starting to pay attention. The Czech foreign minister is traveling to the US to discuss critical minerals. Silver isn't just an investment. It's a strategic material, and critical materials become a topic of discussion when they're becoming scarce, not abundant. When governments start talking about supply chain security, when critical minerals become national security issues, charts and paper prices stop mattering. Physical availability becomes everything. Paper can be created infinitely. Physical silver cannot. The Czech foreign minister traveling to the US to discuss critical minerals is not a coincidence. It's confirmation. Governments are waking up to the fact that China controls the physical supply while the West remains trapped in paper games. We called 86 or lower if Judy Shelton wasn't selected. She wasn't. We hit 86, then 78. And while paper collapses, the physical market tightens into a national security concern. That's the disconnect stackers understand. Stackers aren't paranoid. They're early. What China is doing is brilliant. No fireworks, no headlines, just a consistent 19 to 20% premium that quietly drains Western vaults, forces COMEX margin hikes that choke paper liquidity, and positions China as the physical price setter when paper markets finally lose credibility. That's the war of exhaustion. That's the long game. Now here's the kicker. PPI inflation just came in hotter than expected. December PPI printed at 3% versus expectations of 2.7. Core PPI jumped to 3.3% versus expectations of 2.9, the highest level since July 2025. Inflation is running hotter than expected. And what happened? Silver got dumped. Gold got dumped. Inflation hedges sold off on higher inflation news. Does that make any sense? Of course not, unless you understand these are rigged, contrived markets where prices are set, not discovered. For decades, the LBMA and COMEX have proven they cannot operate free and fair markets. The last 24 hours are simply the continuation of that behavior, and it goes beyond precious metals. Copper is badly underpriced. A massive shortage is brewing there too. Stocks are manipulated. Prices are engineered. What if this is intentional? What if the goal is to destroy smaller PM dealers by unleashing unmanageable volatility? What if the plan is to destabilize broader financial markets to justify consolidation into fewer hands? You'll own nothing and be happy. Ever wonder how that happens? You're watching it unfold in real time inside these fake manufactured markets. Now let's address the bearish case. We hit 86 or lower as predicted, and now we're at 78. The technical damage is real. The 90 to 95 support broke. The 86 level failed. Selling pressure continued. Momentum is bearish. The Fed chair pick wasn't Judy Shelton. Wersch is anti-QE. Markets are pricing tighter liquidity even if rates fall. Hot PPI inflation doesn't matter if balance sheet contraction is coming. Inflation should be bullish for gold and silver. But if liquidity tightens, paper prices can stay suppressed. Paper markets can remain irrational longer than leveraged traders can remain solvent. If you're over-leveraged, this environment will wipe you out. COMEX margin hikes are flushing weak hands, and it's working. There's another risk. If Wersch actually cuts rates while shrinking the balance sheet, we could see a prolonged liquidity squeeze across all assets, including precious metals. The QE era may truly be ending. That would be a historic regime shift. Markets haven't priced a world without QE in over 15 years. The adjustment could be brutal. But here's why paper bearishness doesn't invalidate the physical bullish case. Reality is accelerating. Physical assets now have alternatives. China is becoming the true center of silver price discovery. That renders the fraudulent US and London paper markets increasingly irrelevant. A 60% gap between paper and physical cannot exist indefinitely in a real market. We are in the death throes of a debt-based fiat system. Ministers are flying internationally to discuss critical mineral supply chains. Shanghai vaults are draining 5.6% in a single day. SHFE inventories are down to 14.6 million ounces. COMEX margin hikes hit $52,000 per contract. These are signs of physical stress, not weakness. China's strategy is working. Steady premiums, quiet accumulation, margin hikes that kill Western leverage. And when paper finally breaks, when arbitrage forces physical delivery at scale, China will be the dominant holder and price setter. That's the end game. That's what stackers see and traders miss. So where does this leave us? 3 key takeaways and we're done. Number 1, the technical roadmap played out exactly as outlined. The 150-hour EMA held briefly with a 10% bounce, then broke. The 90 to 95 zone failed. We hit 86 precisely, then dropped to 78. Traders can use these levels. Stackers can use this dip. Know who you are? Number 2, Kevin Wersch, not Judy Shelton, means the battle continues. But the regime is changing. Rate cuts with balance sheet reduction signal the possible end of QE. That's bearish short-term for paper, but massively bullish long-term for hard assets. Number 3, China's war of exhaustion is succeeding. A 56% Shanghai premium. Vaults draining rapidly. Margin hikes crushing paper liquidity. Governments discussing critical minerals. This isn't about daily price. It's about physical scarcity becoming a national security issue. The unresolved question is this: does 78 hold, or do we see one more flush lower before physical reality overwhelms paper manipulation? As China drains vaults at nearly 6% per day with a 56% premium, how long before Western inventories reach critical levels and force a pricing reset? I called 86 or lower, and we hit it. Now we're at 78. Technicals are unfolding, physical fundamentals are screaming scarcity, policy is shifting away from unlimited QE, and China is quietly winning the war of exhaustion while the West argues over paper prices. This is the disconnect. This is the opportunity. This is the moment where you decide whether you're stacking physical reality or trading paper fiction. Do your own due diligence. Understand the risks. If you're trading leverage, this volatility is a meat grinder. If you're stacking physical long-term, this is exactly how generational opportunities are created. Time will reveal who understood the game. Invest with logic, not hype. OG out.